My name is Debbie Burkham, and I am a financial coach here at the Elder Financial Safety Center. And this is just gives you a little bit of background about me. My role here is to help older adults avoid the dangers of financial uncertainty and exploitation as a Elder Financial Safety Center financial coach. I've been serving the nonprofit sector for about 20 years or more at this point. And my specialties include consumer financial education, budgeting, credit counseling, debt management, and housing counseling. And just as a personal note, my husband and I are also cattle ranchers, so we raise cattle. So to get started, one of the things that I learned not too long ago is that Northwestern Mutual, each year they do a study. And one of the things that was revealed from their study this most recent year was that about 33% of Americans' monthly income is going towards debt repayment. So think about that for a moment. That's 1/3. So if you receive $1,000 of income per month, or I'm sorry, if you receive $3,000 of income a month, 1,000 of it is just going towards payment of debt. So that's a pretty significant amount, and it can definitely stifle some major financial goals. If you're in a position where you are repaying debt, it may be preventing you from putting money aside for emergency savings. It may be putting you in a position where you're not able to save for some major purchases, such as if you have a goal to purchase a home or save for your children's college, or even things like just being able to take a family vacation each year. And so the main thing about debt is that education is key. Learning how to deal with debt, learning how to stay out of debt, learning how to manage that debt, just really learning about money management, good practices in general, really kind of helps to avoid individuals and families from getting into those situations where debt becomes just a huge burden for them. And so we've heard in the past that there is such a thing as what's called good debt and bad debt. And so let's talk about those for a moment. What are the rules of good and bad debt? And do they still apply in today's times? Good debt in the past has meant that it is any type of debt that helps you to build wealth or accomplish something that will contribute to your increased income. So good debt would be defined as things like a mortgage payment or college student loans, because student loans would allow you to become more educated, get your degree, and then with a degree, you should be able to go and find a better paying job, enter into a career that's going to be supporting you for the rest of your life. And then a mortgage payment should be something that is providing you with housing that possibly will be there for you in your retirement days, where it's fully paid for. It's also an investment, because as you make your mortgage payments, you are paying down the debt and probably increasing your net worth, because you're building equity. And not only are you building equity just through paying down the debt, but typically property values have increased over years. And so when you purchase a home that maybe it has $100,000 mortgage on it, and the value is 100 and say 20,000, but 30 years later, that home could end up being worth, 300,000. And so it's helping to build wealth. So do those things still apply? As you may recall, back in 2008, 2009, we had a housing crisis. And a lot of people were in a position where they couldn't afford to pay their mortgages. They found themselves in loans where they owed more on the home than what it was worth, and they couldn't sell it. The debts were, or the payments were getting to be a struggle. A lot of people were losing their jobs. They were finding themselves in a position where they may be foreclosed on. So during that time, I'm sure a lot of people were questioning, was this really a good investment? Did I make the right choice? And so that is just kind of a matter of when you go into purchasing a home, you need to make sure you know what you're getting into, know the type of loan, know what the terms are before you sign on the dotted line, and make sure that you feel comfortable with taking on that debt, because it may turn out to not be a very good investment later on. And the same could be true for student loans. There may be some of these for-profit schools who charge higher tuition rates. They're offering or helping you get into loans that may be private type loans, not government guaranteed loans, and allowing you to take on too much debt, whether that's for you going to school yourself, or whether you're helping a child or a grandchild pay for that education. And so a lot of times too, people have found themselves where they may come out of college and struggle to find the high paying jobs that they thought they were going to get. They're either not there, or maybe they entered into a degree field that was already heavily saturated, and there's not a need for whatever that particular degree plan is. So just make sure that anytime you're trying to take on a loan for some purpose like that, make sure that you have done your research and you know before you enter into that type of loan. And then let's talk a little bit about the ugly debt. These are the ones that are going to be high interest. They are going to cost you a lot of money over the course of time. Of these that you see listed here, you'll see credit card, pawn shops, rent to own, rapid refund, payday loans, and title loans. Of these, credit cards are going to be of the lowest interest, but you may still find that you have a credit card that could have 24% interest, 30% interest, depending on the type of credit card. On top of that, credit cards, if you're ever late paying, you're going to pay a late fee. If you go over your limit, you may be paying over limit fees. And so if you fall behind, obviously they can affect your credit by being reported as late or over the limit. Pawn shops are another bad type of loan. They typically have interest rates that can run into the triple digits. And so they're just not a good option for trying to finance something. I understand people use these as a way to get money in an emergency situation. But there again, if it is an emergency situation, let's maybe try and look for other possible options rather than defaulting to that type of loan where you're paying those high interest. Rent to own is another one. You may not realize just how much rent to own costs over time. But let's say, for instance, you're needing a washer and dryer, and you go to one of the rent to own places and they set you up on weekly payments. By the time you have paid off the contract, you have probably paid at least twice and probably 3 times what it would cost to have just gone to Home Depot, an appliance store, Lowe's, somewhere like that, and paid cash for it. So if there is a way to save the money and then buy it outright, it certainly is much more affordable. We're not in tax time or tax season right now, but we will be coming up on that after the first of the year. And so you may have heard of these rapid refund loans where you can get your money back in as little as a couple of days if you're expecting a refund. What you may not understand is that these are loans and they typically can have an APR calculated out at 80% or more. So you're getting the use of somebody else's money very quickly, but they're going to charge a hefty fee for being able to use that money quickly. Typically on a income tax refund, in most cases, especially if you're e-filing and doing direct deposit option, you can get that money in maybe as little as 2 weeks. So if you can wait 2 weeks, that's the better option. Payday loans are awful. You're looking at probably 300% and 400% interest rate on those. If you borrow $500, you may end up paying back $1,500 or $2,000 over the course of several months. So those are just really not a good option at all if you can avoid those. And then finally, car title loans are also horrible. The interest rates are horrible. But most people that we've talked to who have a title loan find themselves in a position where they are about to lose their car because they can no longer keep up with the payments. So before turning over the title to your vehicle in exchange for a few $100s or $1,000, rethink that and try for something different. So we also want to just make sure that you're aware of different types of debt collection scams. Those are, they're all over. Typically, it may start with a phone call. Sometimes it's what's called phantom debt collection, where you may receive something in the mail or an email. Text messages even. Debt collectors are starting to use, or fake debt collectors, scammers are starting to use text messaging as a way to try and scam you out of your money. So make sure that you recognize the signs of what could be a debt collection scam. Some of those signs include they may have some basic information about you and where you live, your phone number, to make it seem like it's a legitimate debt collector. They may use high pressure tactics such as threatening to send you to jail, have the sheriff come and get you. They may threaten to garnish your income. So it's very high pressure and they are threatening. And so those are some of the signs that you need to be aware of. How should you respond if you were to receive a call like this? Well, one of the things that we always tell our clients is if you have caller ID, don't even answer the phone. If it's not a number that you recognize, just let it go to your voicemail. And then if it's truly an important call, that person will leave a message. Most of the scammers who are doing these fake debt collection calls are not going to leave a message. Or if they do leave a message, before you call them back, take a few steps to check it out first and see if you think it is a debt that you really owe. And before you call them back, be prepared. What you want to do is you want to ask them their name, who they work for, what their address is, and don't ever give your personal information out over the phone. Don't send it in an email. Don't send it in a text. And then finally, ask them to send you something in writing before you ever turn over any money to them for repayment. The reason for sending something in the mail is because that does help legitimize the debt collection effort, because as you know, there are rules for using the United States Postal Service for that type of thing. So I would just say, if you have any questions about it, feel free to give us a call, give me a call. If you're not sure if it's a legitimate debt, we can help you determine that. Okay, so what if you do have some debt and you're not sure what to do about it? These are some options that you can consider. The first option would be self-pay, which means you can continue to try and pay the debt like you have been. You can call your lender or your creditor and ask about internal hardship programs. Internal hardship programs are done with the creditor, and they may include things like a reduction of the interest rate or a reduction of the payment, or a combination of those things. Another option is debt consolidation loan. So this might be a good option for somebody whose behavior patterns for repayment are good. They're just trying to find a way to get that payment get those payments for those other debts consolidated, and hopefully for a lower interest rate so that they can just start to see a little bit faster progress for paying down the debt. A debt consolidation loan is not a good option for somebody who may be in a practice of using debt in emergency situations often, or to pay for basic needs. Because if you take out a debt consolidation loan, it pays off your credit cards, and then you go right back to using your credit cards. You're going to find yourself with more debt than what you had before you took out a debt consolidation loan. Debt management plans. This is another option. These are plans that are done through legitimate nonprofit organizations. They have policies in effect with most all the creditors, especially all of the major creditors. And the way these work is like a snowball effect. So you pay the debts through a debt management plan. When one of them gets paid off, that payment that was designated for that one creditor now goes to the other creditors. So your regular monthly payment never changes, but as your debts get paid off, more money gets assigned to the remaining debts on the plan. And this is something you can do even on your own, just by starting with like your lowest debt, put extra money towards that one. And once it's paid off, then whatever you were paying towards that one, you put towards the next lowest debt. So that's another way you can do that on your own. Debt settlement is another option. Debt settlement is where you repay less than what you owed. There are debt settlement companies out there that may offer to help you. I would say definitely those need to be avoided. They usually charge high fees that are hidden in some way or another. Debt settlement is something you can do on your own with your creditors. You call them up, you tell them, you know I have this debt. I would like to address it, but I just can't pay the full amount without it being a burden. Can we work something out? And it's likely that the creditor may work with you on a debt settlement. The one thing to know about that is if you do work out an agreement with them, you need to be prepared to make that payment at that time. Usually the full payment that you agree on, or they may break it up into 2 or 3 equal payments, but they usually won't stretch it out over a long period of time. Another option is bankruptcy. This is an option for someone who is looking for a fresh start. In other words, eliminate the debt, get rid of it, and then let's get our lives back on track. This may be a good option for someone who is maybe younger and just has a overwhelming burden of debt. that they can't take care of. And so, but they do want to have the goal of being able to get a loan sometime in the future, such as a car loan or a mortgage. So bankruptcy is not for everyone, but it may be an option for some who are looking to have that fresh start again. And then the other option is you could just ignore the payments completely. And I know that sounds kind of odd to just not pay your bills, but in some cases where maybe you're on a fixed income and you're just barely able to pay the cost of your housing, your utilities, your groceries, and your medical care and your transportation. And if that's really all the income that you have that can cover those things, it may very well be the best option just to contact those creditors and say, I'm sorry, I know I owe this debt, but I can no longer pay it. The one thing about being in the state of Texas, if you are only on Social Security, there's not really a lot that a debt collector can do to you. Even if you have other sources of income, there's not a lot that a creditor can do for trying to garnish your income for unsecured debts. If it is a student loan, an IRS debt, or some type of government guaranteed loan, then yes, they could offset your income, but usually that's only at about 15%. But for unsecured debts, they're not going to be able to garnish your income. So before we move on to credit, do we have any questions about the debt portion of our presentation?
We do have one question in the chat about if someone accidentally picks up the phone when a scammer calls, are they able to have some kind of connection to the phone where they can listen to the calls? Which I believe the answer is no, but I wanted to discuss with you.
Okay, so this would be like a debt collection call?
Actually, no, if it's a scammer.
Oh, a scammer.
A little bit of a left turn, but if a scammer calls and instead of going to voicemail, if someone were to accidentally answer the call, they then have some kind of connection to the phone where they can listen to the calls.
Oh, I would say if once you've determined that it's probably a scammer, it's okay just to go ahead and disconnect that call and just not even engage in that conversation because they have perfected their craft, so to speak, and they know the things to say and do to try and keep you on that phone call and to engage you and encourage you to hand over your money in some way, shape, or form. We hear all the time about individuals, clients who get scammed through what's called the grandparent scam. We know that romance scams are on the rise through social media. We've heard the stories about the IRS calling, threatening to put you in jail. And so IRS is not going to come to your home and put you in jail. They're not going to call your home. They're not going to email you. Typically, your banks are not going to do that either. Not through email and things like that. So if you get a phone call and you pretty much have determined that it's probably a scammer, it's best just to go ahead, hang up, don't be polite, and don't engage that caller.
You haven't heard of a situation where they're then able to listen to personal phone calls, right? Where they have some connection and can then listen in.
That I'm not aware of.
I don't think that's typical.
Yeah, that's probably not the typical one.
Thank you, Debbie.
Okay. So let's talk about credit for a moment. So for credit, what is credit? Well, credit is the ability of a customer or someone to obtain the goods or services before payment. It is based on trust. that that customer or that borrower will make those payments in the future. So that is the ability to use someone else's money for your own personal gain, to pay it out over time. And usually you're going to pay it out with interest. That's how the lender makes their money, is they do charge interest. And so how that interest is determined is based on several factors. And we'll get into those different factors here in just a moment. So there's two different things here. There's a thing called a credit report and then a credit score. Credit report is it's a statement of information about your credit activity and your current credit situation, such as how many loans you may have, what your payment history is like, the current status of your accounts, whether they are in good standing or whether they are past due or whether they are in collections. And all of that information is collected by the credit bureaus. It is furnished to them by your creditors, your lenders, and then they compile all that data and information into a pretty little report that lenders, potential lenders can receive when you apply for credit or when you file or elect to get a copy of your own credit report each year to review for your personal reasons. Credit score is going to be a number that is calculated based on that information in your credit report. It is a 3-digit number, and that is used by lenders to predict how likely you are to repay a loan. And so credit scores can be different types. The most common one that we hear of is the FICO score, but there is also one called a Vantage score. They have different purposes. Typically, the FICO score is the one that's most used by lenders. Vantage score is probably going to be a little bit more popular or used by consumer type industries. Say if you are applying for a car loan. So a lender may prefer to have like a Vantage score as opposed to a FICO score if you're applying for a car loan. So let's talk a little bit about what things determine that trust. How do you build that trust through your credit report? Well, it's through your behaviors. And these are your 3 C's. I'm sorry, your 5 C's of credit. So you have character, capacity, capital, conditions, and collateral. How is character determined? Well, character is going to be determined based on your behaviors. How have you paid those bills in the past? How many times do you apply for credit? How much credit are you currently using? And so those are going to be the factors that determine so-called character. Are your bills paid on time? Are you applying for credit frequently? Several times a year. And what's the purpose of applying for that credit? And the next item here is going to be capacity. So capacity is, do you have the ability to repay the loan that you're applying for? Capacity is going to be indicated by your income and what types of income you have and whether that income is sustainable, how long it's going to last. Capacity would be your income from employment. It might be income from child support. It might be income from rental properties. It might be income from royalties. It might be income from spousal support, or it might be income from Social Security or pension. And so creditors look at how much money you have coming in and how does that compare with the amount that you're asking to borrow. And that's how they determine your capacity or your ability for repayment of the loan. The other item here on our list is capital. So capital is going to be, capital is your skin in the game. Capital is what are you bringing to this relationship between lender and borrower. So for instance, if you're applying for a mortgage loan, the lender wants to know how much money have you saved that you can put down on the property. A lot of lenders for conventional loans are going to require 20%. So for every $100,000 you're borrowing, they're going to want you to put down $20,000. If you're applying for something like an FHA loan, they don't require near as much capital or down payment. Those types of loans only require about 3.5% down. If it's a car loan, or do you have something that you're going to trade in that's going to become a down payment? Or do you have savings that you're going to put towards that car loan? Or are you asking to finance that 100%? So more skin in the game, more money down, more capital will probably result in a more favorable decision and will probably result in more favorable conditions. So that brings us to our next one. What are the conditions of the loan? Conditions would be things like how long do you want to borrow the money, and what is the interest rate going to be, and what is that loan going to be used for? There again, is it just a personal loan, a signature loan, where you use that money for whatever reason you want it, and the borrower, or I mean the lender really doesn't know what you're going to use it for. It's just a loan that you're applying for so that you can use those funds for whatever reason. Or is it a loan for a mortgage, or is it a loan for a car? And so those are all things that play into the fourth C of conditions. And then of course, interest rate. Higher interest rate equals a higher payment. Lower interest rate usually means lower payments. And then how long do you want to borrow that money? For a mortgage, is it going to be 30 years, 20 years, or 15 years? For a car loan, are you asking to finance that vehicle for 3 years, 5 years, or 7 years? So in that particular situation, financing it for a shorter period of time might result in a more favorable decision, approval of the loan, as long as you can show the capacity to make those payments. And then the last one is collateral. Is there anything that backs up this loan? Is there anything there that the lender can come back and take should you default on the loan? Obviously, in the case of a mortgage, if you don't make the mortgage payments, they can foreclose on the property. And the same for a car loan, a vehicle loan. If you don't make those payments, they can repossess the vehicle. So those are all the things there that help to determine and build trust when applying for a loan with a lender. So why is credit important? Credit is important because that's your financial resume. Your credit report received by a lender is usually the only thing that they have to go on. We're outside of the days now where we had a one-on-one relationship with our banker. Everything now is done so much online iPhone. And so we don't seem to really have that personal relationship with someone at the bank up the street that we used to have many years ago. So the only way really for a lender to tell if you're a good credit risk or not is based on what's in your credit report. And that helps them to determine, what your financial behaviors have been like in the past. And they can use that to determine or predict what your financial behaviors may be in the future. Credit's also important because it determines sometimes what you may pay for items. And there again, that goes back to interest rate. If your credit is good and you're say over 720 on your FICO score, you're going to benefit by getting lower interest rates. And over time, that interest rate results in a finance charge. So your overall finance charge will be less when you have lower interest rates. And you can really see that in like a mortgage. When you finance a property at say $200,000 and you finance it for 30 years at 4% interest, well, then you get to see at the end of 30 years just exactly how much you've really paid for that house. And it's usually way more than $200,000. Your credit may determine where you might live. Well, how does that work? Well, say for instance, if you are renting, whether it's renting a house or an apartment, a lot of times property management will run credit reports. And so if you've had a situation where you broke a lease and you have a judgment for that rent that you didn't pay, well, that new agent or that new landlord may not like that and may decide that they don't want to approve you to rent or to be a tenant in their property. It might also determine where you work. So certain jobs require maybe some level of security clearance. They also could include things like managing money at a bank or securities or insurance. And so if your past behaviors financially show up on your credit report in the form of collections and slow pays, then that could predict maybe how your behaviors would translate in your work life, and how you would be as an employee. Certainly in positions of, say, law enforcement, if someone's in law enforcement and their credit's not good, would that make them susceptible to bribes? So that's where your credit report might determine where you work or what your job can be. It can determine what you drive. So obviously, if you're applying for a car loan, your credit's good, you may be able to get approved for a little higher loan, which could get you maybe a car that has a few more features that you want, maybe a luxury item, as opposed to something more basic. And then it also can affect your monthly bills, your utilities, and your insurance. So insurance companies run credit reports to determine how much you may be paying for a premium. There again, that ties back into financial behaviors. If you're in a situation where you're new, especially like with our grandchildren who may just be starting their adult lives and they don't really have a lot of credit, when they go to apply or get their first apartment and they need electric service, water service, phone service, they may find that they're having to pay for a deposit on those things because they don't have credit. But as they build credit, that will change later on and they may not have to pay those deposits. So let's take a look at how credit scores are calculated. The biggest factor in determining your credit score includes your payment history. And payment history on a credit report will go back and look at years of payments on a loan. So if you've ever looked at your credit report, you'll see that they will show going back as far as the life of the loan, at least 4 years if you've had the account for that long. Your payment history every month for each year that you've had it. And it may show okay. So there'll be these little boxes and they'll say okay, 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 okay. And then you might see a 30 for one of those months. Well, that means that the creditor reported that account as being 30 days past due for that month. But if you have a string of okays, well, that's good. That means that you're doing well at keeping your payments up to date and current and in a timely manner. The next most important item is how much do you owe on your accounts? So if you have a lot of different open accounts, how much of your credit are you using? Say, for instance, you have maybe a Walmart card with a $2,000 limit. But if you've got $1,999 of that credit that you've already used and you only have $1 left that's available in credit, that is something that plays into how your credit score is calculated. So it's always best if you have credit to try and pay off those debts every month. Use the card, pay it off, use the card, pay it off, or at least not carry a balance for more than a couple of months or a few months if you can do that. And certainly try not to go over about 30% of your credit line that's available if you can avoid doing that. Certainly if you need to, that's understandable. But if you do utilize a large amount of your available credit, do the best that you can to pay it off in large chunks and pay it off quickly. 15% of your credit is determined by your credit history. That means how long have you had that account? If you opened your first credit card back in 1981 and you still have that account and you're still using it, you have established a really long line of credit history, and that's good. A lot of times people want to get into a habit of, I want to close this account, transfer the balance over to a new card and take advantage of 0% interest. I can understand wanting to take advantage of 0% interest. But if you do that, just know that when you close that older account, you've kind of shut off now a line of credit where you've established that for a good amount of time. And now you've got a new one that's just starting out and it hasn't just established a payment history on it. A new credit accounts for 10%. So when we talk about new credit, that is how many times are you applying for loans and credit cards and other types of financing. Every time you apply, it shows up as an inquiry on your credit report. And inquiries will stay on your credit report for 2 years. And if you have a lot of inquiries, that might be an indication that there's something going on financially, that there's a reason why you're having to apply for so much credit. So if you don't have to have credit, don't apply for it. I know that we're all tempted, especially around the holidays. We go shopping and someone says, if you'll apply for our credit card today, we'll give you 15% off your purchases. But if you can avoid applying for that credit, I would just encourage you to do so, because if you get into a habit like that, it can affect your credit score. Not significantly. We can see here that it's only about 10%, but it does have an impact. And then the other item here is your types of credit. Types of credit would be, do you have a nice mix of credit? Do you have some installment loan history? Do you have mortgage history? Do you have some credit card history? Do you have student loan history? So if you have had a mortgage, you've had an installment loan, such as a car payment, and you have a credit card, and all of those are in good standing, well, then that helps to indicate to potential lenders that you've been good about paying those debts, different types of debts, and that you're probably a good credit risk. And then finally here, I just wanted to share with you some of our resources, places where you can go to get really great information about consumer issues, credit, debt, scams, all of that. One of my favorites is the Federal Trade Commission. So that's ftc.gov. And they have a consumer information tab. And if you click on that tab, you'll see all sorts of topics covered, from credit, debt, scams, buying vehicles, all sorts of good information there. mymoneydfw.com, that is a United Way site. So they have some good information there for money management and consumer issues. Consumerfinance.gov, that is the CFPB, the Consumer Finance Protection Bureau. This was the agency created out of that recession from 2008, 2009. The first person to head up that agency was Elizabeth Warren, and they are, so that's a lot of good information there. And also they have a place there where you can file complaints if you have a complaint against your mortgage company, your bank, things like that. You can file complaints through the CFPB. And then annualcreditreport.com. This is the place where you go to get a free copy of your credit report. This is a single site that will allow you to pull the credit report from Experian, Equifax, and TransUnion. It used to be that you were entitled to one free credit report from each of those three bureaus every year. And then during the pandemic, they loosened that up, and you could pull your credit report as often as once a day if you wanted to. I wouldn't really say that that's necessary, but pulling your credit report is a good idea because sometimes it will help you to find things, errors or things that might show up that could indicate that there's been some identity theft. So if you're not in the habit of getting a copy of your credit report at least once a year, and you're not sure how to go about doing that, give us a call and we can help you do that. We'll help you pull your credit report and review it with you to make sure that everything looks correct. Of course, we are here to help. Again, my name is Debbie Burkham, and you'll see there, that's my telephone number. And you can also contact me by email. That telephone number, we even receive text messages there. So you can, if you like to text, then that's an option as well. Just tell me who you are when you text, because I only see a telephone number. Do we have any questions?
We don't have any others from the chat.
Oh, excuse me, I put some in, but I might have sent them to the wrong person.
Oh, okay.
I think
You
I
can say
put,
them out loud.
okay, yeah, thanks. I'll read them to you. Let's see, I have to find them. So my question is, would you say a credit score influences car? This is my first question. Can you, okay, would a credit score influence your car or medical insurance rates also?
It would influence your vehicle insurance, and it could impact your homeowner's insurance rate
Yeah.
somewhat. Typically, the biggest portion of that, and I think Carl hasn't done insurance yet, has he? That's coming up. So that would be a good question if you can make the virtual session on insurance. Carl Burlbaugh is going to be doing that, but just a quick answer for you without stealing his thunder. I would say, yes, it could impact your vehicle insurance premium, and it could impact your homeowner's premium. I don't think it would impact your health insurance premium, but that would be a good question to ask for him.
Okay, thanks.
Mhm.
Yeah, my other question is, if you have a lender check your credit score, but let's say a bank or a mortgage company, but then you don't decide to go ahead with applying, does that, I've heard, if you get a lot of checks on your credit score, or you have a lot of inquiries into your credit history, it lowers your credit score? Or isn't something like that the case?
Yes, so there's what's called a hard inquiry and a soft inquiry. A hard inquiry is where you are actually applying for a loan, and that will show up. Not only can you see that, but other lenders will be able to see that hard inquiry. Soft inquiries are going to be where you may be checking your credit report, just you, or it might be that somebody that you've currently in a relationship with, a business relationship, such as your bank or your insurance provider, they may be doing just these soft checks on your credit that they are permitted to do because when you entered into that relationship, whether you know it or not, you may have given them that authorization to check your credit periodically. And then pre-screened offers are also considered soft inquiries that will not show up. But when you apply for a loan, that is a hard inquiry, and it will show up, and it could impact your credit score. Not significantly, but if you're doing it a lot, then yes, it could.
Okay, so if you,
have-
go ahead, sorry.
Okay, I have a statement. When I retired, I paid off all my accounts, and that's been something like 15 years ago. And I thought I was doing a good thing by paying everything off.
Mhm.
So now I have zero credit, and that's worse than bad credit.
That's a very good point. Yes, ma'am. That is true. There is a lot to be said for living life without debt. And I think it's something that we all strive for, but it is good to have some credit. So if you have, if you do banking like with a credit union, that might be a good place to go to maybe open up just a one little credit card account with them to help us reestablish your credit. Use it, pay it off, use it, pay it off. But I applaud you for paying all those things off 15 or so years ago and not getting back into debt. So
Well, my income was increasing, so I'm like, okay, I'm gonna pay everything off, and I'm not gonna owe anybody. Which now, when I got 2 apartments I've lived in since I retired, and I had to pay an extra deposit because I had zero credit.
yes. So maybe, maybe go to your credit union It sounds like you have good habits, good financial habits. So I wouldn't expect you would get into any kind of trouble by having one little credit card.
Debbie, we have a comment in the chat that says you would still have credit if you keep the cards open with a $0 balance,
Say
Um,
again.
right?
Yes, so the comment is that you would still have credit if you keep the cards open with a $0 balance. That is true, but keep in mind that 35% of your credit score depends on payment history. So if you have a $0 balance, you're not making any payments to those. And eventually, if those cards go long enough without any activity on them, then it's possible that that creditor may just close the account on their own due to inactivity.
Yeah. Okay, thank you.
So I have another question.
Okay.
Okay, sorry. I've had problems with computer security in the past. And so I hate to put financial information on the, on my computer or, like my social security number or whatever. Is there a way to request my credit report without requesting it online?
Yes. Yes. So that annual credit report .com, you can also call them toll free, and I can give you their telephone number. Or you can request your credit report by completing a form, a paper form, and mailing it to them. And we have those forms as well if you wanted that. You will have to provide your social security number because your credit report is going to be tied to your social security number, but at least that's a way that you don't have to do it online and putting that information out there on the, on your computer if you choose not to. The toll-free number is 1-877-322-8228. And so I will throw that here in the chat.
Thank you.
And if you prefer to apply with a paper form, I can do that as well. Let's see, that's the request form. Any other questions or comments? Yes, Miss Rosa.
I heard you Ms. Galaxy about she doesn't have no credit to go to the bank for credit or a credit card now, and just to use it, pay it. Now, does it matter also the amount that you are using on the credit card and paying it out, using it on the credit card and paying it out? Does that help you to get a good credit?
So let's say, for instance, if your credit card has a $1,000 limit, if you can keep your spending to $300 or less, and then, pay it off in like 2 payments or 3 payments, pay it off quickly. Instead of $25 a month, you're paying $100 a month. That's better for your credit score than, say, if you have a $1,000 limit and you go and charge $1,000 and then you're paying it off at, $50 a month, and obviously accruing the finance charges. The payments, as long as you're making the required minimum payment, you're making them on time, is still going to be good and it's going to help you build credit. But where it's going to hurt is that you have utilized all of the credit that was available on that particular account. And so that will bring the score down. And we'll tell you that scores are never, ever going to be the same. You can look at your credit score today and tomorrow it's going to be different. One lender can look at your score right now, and then you could go to another lender an hour later and they can pull the credit report and the score will be different from them. And the reason is because the FICO score can be altered based on the calculations that that particular lender has. It can be weighted, so to speak. So if you're applying for a car loan, car dealers or car lenders care more about how you've paid a car loan in the past. They may not care so much about how you paid your credit cards, but they do care about how you paid a car loan. So they can ask for that calculation, that algorithm to be weighted a little bit more towards how did they pay car payments. If you had a mortgage, the lender's going to care more about how you may have paid your rent in the past or how you've paid other mortgages. They may not care so much about other things. And so the FICO score is not going to be a constant. It's always going to be moving depending on the day, the time, the lender, so there's different factors that my husband used to irritate me so much because he was watching his credit score every single month. And if it changed just by 4 points, whether it was going up or going down, he would ask me questions like, why is my credit score doing this? It's like, just don't watch it so closely. 4 points doesn't make a difference. 100 points can make a difference. Maybe 50 points can make a difference. But 1 or 2 points is not really going to be that big of a factor. So, if you're at 720 or above, you're in good shape to get competitive rates if you're applying for a loan. If you're under 720, then that would indicate that you're a little bit more of a credit risk. But there again, 719 to 720 could just be the difference between one lender to the next. Any other questions or comments? Did you have one, Rosa?
Yes. Also, I've heard that if you say you're renting an apartment, and also it depends on how long you've been renting and living in that apartment or that house, that also counts a lot in your credit. Is that right? How long?
It can. It could. And keep in mind too that there is a whole separate credit. I'm not sure what the word I'm looking for right now, but there is a source, a place where landlords can go to get information about rental history for a potential tenant, which is separate from just applying for or reviewing your credit with Experian, Equifax, or TransUnion. So there is this other layer that looks at rental history as well.
Sorry. And also another question, not paying your bills on time, like the water, the gas, and things like that. That also counts for you to be able to get credit or another apartment or something like that. Is that right?
So your utilities are not going to be that much of they're not really going to be a factor on your credit score because they don't report to the credit bureaus on a regular basis. The only time that, say, a water company, an electric company, a phone company will report to the credit bureau is if you have not paid and it has now been turned over to a collection agency, and it appears then as a collection account on your credit report. I will tell you that if you don't, if you default or fail to pay a utility bill and it goes to collections, that does matter to potential, to your landlords. If you're gonna move to another apartment and there's a collection account for a water bill or an electric bill, that does matter to them.
Oh, okay. All right. Well, thank you very much
All right, you're
for
welcome.
your information.
And Miss Galaxy,
Yeah,
did you have a question?
I have another comment. You spoke about apartment complexes going to different places to look up. The 2 apartments I stayed in were owned by the same company. And I stayed in the person for 10 years. And now I'm in this one and I still had to pay that extra deposit. So never missed the rent, never was late.
Oh my goodness. Yeah, that's odd. So I wish I had an answer for that one other than the fact, like you said, you just didn't have any established credit.
Yeah.
But I would think that since you had been a good tenant for that property management company, that they would have recognized that when you were moving to another property under that same management company. I want to thank all of you for joining us tonight. And I hope I didn't seem too novice on this presentation. So, but if you have any questions, feel free to give us a call and we'll help you any way we can.